Kelly Barenbaum, who's my financial advisor that's been telling me to set up a 401k. She's asking, Jason, can you talk about Roth versus traditional 401ks or IRAs and how to think about / plan for required minimum distributions?
Yeah, great question. And definitely someone that's thinking of the holistic picture. So I love that. 401ks and IRAs from a pre-tax and post-tax are the same. The rules are the same. So we'll just take both of those off and just say traditional and Roth. And when we say traditional, we mean everything that's not a Roth, right? Pre-tax. So you have two choices when you put money into a retirement account. Either pay the tax today, which is the Roth, and don't pay it later, or get a tax deduction today and then ultimately pay the tax later, right? Now, again, my opinion, and for full disclaimer, it's only my opinion, right? Every situation is unique. So I genuinely may talk to your advisor, your accountant, and really understand it, but ask the right questions. So remember I said earlier, I default to Roth and then it's traditional because I have to, not because I want to. And I say that because for a couple reasons. Number one, if I have the ability to buy Uncle Sam out of my transactions for life, I'm taking it. I don't care. You can tell me, well, what if the tax rate this? I'm not playing that game. You tell me Uncle Sam will not touch a penny of the earnings of this money from today forward. You got me. And I know that because the tax rate that I have to pay is my current tax rate. So even in the highest tax bracket, I'm still making that bet personally. Right? I'm not thinking twice, but I understand for those of you on the call, maybe you do think twice and that's okay. But I just would challenge you to think the other way, right? It's not innocent till proven guilty, guilty till proven innocent, right? And so I want to be guilty as charged for this Roth until maybe I back out of it for whatever reason. The reason that's so critical is because if you think about the way investments work over time, you're not just buying an investment, right, tax-free. So let's just say I take, and I'm using round numbers, but let's just say I take 100 grand, right, and I buy an investment, and that investment grows to 120. A lot of people say, well, that's 20 grand of profit, 20 grand of profit plus tax is X. What they don't calculate in is a couple things. Number one, that tax bill likely has to be paid. That's money lost, right? The second thing is that now 120 that reinvests is going to have another tax bill. And then I reinvest it, it's going to have another tax bill. When I have a Roth, I've bought every one of those transactions tax-free. So you can actually basically offset 8, 10, 12 times. So not getting too complex in taxes, but when you buy these deals in your personal account, depreciation is a temporary solution, right? And it is going to come back at the end of each deal, right? You don't get rid of it forever. It's a great thing, but it's not as good as a Roth. The last thing I'll just illustrate, right? And this is how it works. $1, right? Everybody takes $1 and we double it every year for the next 30 years. $1. $1 becomes 2, 2 becomes 4, 4 becomes 8, right? You get the idea. And we're going to do it under two scenarios, right? So this time I'm going to use GC is the person that uses his personal money and Pablo uses his IRA, right? And then inside the IRA, we'll go down to the Roth, right? So GC takes $1. He puts it in the same exact deal. It earns another $1, right? And he pays 25% tax because he owns it in his personal account. So now he's got $1.75. It doubles to $3.50. He pays 25% tax and then invests it again. And he does that for 30 years. And 30 years from now, he's on the Not Your Average Investor podcast, and he is sitting here talking, and he is bragging to everybody.
At that point, it'll be the biggest podcast in the world, just FYI.
So yeah, to the millions, possibly billions at that point of listeners, he is saying, guys, I turned $1 into $78,000. And everybody's like, oh my God, holy shit, that's incredible. This guy just turned $1 into 78 grand, right? And in Gregg's eyes and most of our eyes, because we don't know how the wealthy live, think, and operate, we're like, woo-hoo, nailed it. Pablo takes this same dollar, puts it in the same investment, no more risk, no less risk, no more savings, right? But he says, you know what? I'm going to use my IRA. 30 years from now, he's on the show. And he's like, Gregg, I let you have your moment in time. Ha ha. Nice work. Your 78 grand is good. But because I didn't pay that 25% tax every year, I've got 1,058 grand.
Wow.
And everybody, right, is screaming from the mountaintops, Pablo, the man, the myth, the legend. The problem is when Pablo put that dollar in, he cheaped out on the tax, which is 25%, which is a quarter, and he put it into a pre-tax because he thought, I'll just pay the tax later when I'm in the lower tax rate. And so Pablo's right. He's now in the 15% tax rate, and he owes tax on $1,058,000, or about $165,000. Good job, Pablo. But now you've got about 900 grand. So 900 grand trumps 78 grand, right? Here comes Jason.
Yes.
And Jason says, Pablo, I'm proud of you, man. But let me just tell you what I did just a little differently. I took the same dollar, I put it into the same exact investment for 30 years, but I said, here's my quarter up front, and I have the same $1,058,000, but I don't know a lick of tax on it because it's in a Roth. You can see how easy it is to feel like you're being successful while still missing out on major opportunities. And so I paint that picture because it's been painted for me many times in my career here at NewView, but it's that we tend to ignore the taxes, and that tax tail is actually what's wagging the dog, right? Because Gregg's a great investor. He doubled his money every year for 30 years. Pablo's a great investor. He doubled his money every year for 30 years. Jason's a great investor. He doubled his money every year for 30 years. We all did the same thing. But the end result is significantly different between each of us because of a one-time tax decision that we made or didn't make. So let that sink in the grand scheme of how we evaluate our building wealth and financial health, because the investments are critical, but just as critical as the tax decisions that we make. And if I were to say, Pablo, knowing what you know now, would you rather have kept 150 grand and went back and paid the quarter when you put the buck in the account? It's an extreme example, but the answer is, oh my gosh, of course.
I feel like we can just end the show right there. Yeah, we can just end the show right there. Gregg, I'm sorry you lost. Jason, I'm happy to be co-champion with you. And really, really good illustration.